They are closing that gap in terms of productivity, so there are those chances to invest in those certain emerging countries and take advantage of the closing of that gap. And then the second quote, the region's, referring to Latin America, resilience has increased thanks to improved government balance sheets, lower external debt and higher international reserves, more flexible exchange rates, and stronger financial regulation and supervision. So all these are saying there's been a promotion of better government in the region, which has led to the high growth that we'll see in certain of the countries as we look through the presentation. I'm still stuck a little bit in history. Since we're going to talk a lot about GDP, I just want to kind of give everybody a background in how GDP has grown over the years. This is a chart. I don't know they did accurate counting every year, but this is the best estimate from one academic of how GDP grew from the year 0. And actually, there wasn't a year 0. It should say the year 1 to 1820. And you see the first 1,000 years, almost no growth in GDP as the world basically existed in chaos. And there was no acceleration of learning where one group advanced on the back of the next. From the year 1000 forward, you can see pretty good continuing rise in GDP, and as you'd expect, the largest rises were in what were the most developed parts of the world, where trade increased, Western Europe and China, dramatically ahead of the rest of the world. 1820 forward, you can see a continual gradual rise across all economies, so there is that natural tendency. And you can see the developed world and the world with the most liberty, the Western Europe and the United States, dramatically outperforming the rest of the globe. Since we love CAGRs and private equity, I extrapolated these from the chart, and I think interestingly here, you can see without technology rapidly advancing and without liberty, which generally didn't exist in the world at least through 1800, never in any significant period of time was there a 1% compounded growth rate in the world's GDP or any region's GDP. But you can see as liberty has increased and technology has advanced, you can see in the 1800 to 1900 time frame, amounts above 1%, in the United States 3.6%, 3.68% growth. And you can see from 1900 for the next century, you see the entire world growing at more than 2% and three regions over 3% growth. So you can see there is a compounding of growth upon itself as regions both grasp new technologies, implement them in their markets, and increase the opportunity for entrepreneurism. I've covered 3 countries, the U.S., Brazil, and China in this chart, again, just to give you a sense of the growth of GDP over time and try to apply that to Latin America as we go. This is the United States, since we're most familiar with that. The bars show the GDP, and this particular chart is on constant 2000 U.S. dollars. You can see we've grown quite a bit. I can remember, this will date me a little bit, 48 of the 50 years that are shown on this chart. And I can tell you, as a boy who grew up in a small town in Kansas, if you told me we'd gone from a GDP of about 13,000 to almost 40,000 or a 3 times increase, and I'd get 3 times as much stuff, that seemed pretty good. The top line is our percent of the GDP of the world. The bottom line is our percent of the GDP of the population of the world. So you can see a wide gap in our productivity compared to the world. You can also see across the bottom the absolute change in U.S. GDP from each decade covered in that chart, again in constant dollars. You can see the first 4 decades quite good, and then this most recent decade, you can see we grew through the first half of it, and then we've really been stagnant for the last 5 years or so. The takeaway from that, if you kind of look at where 2000, 2001, you'll remember the technology bubble. The technology bubble was mostly privately created, and it had very little impact on the GDP because it didn't range through the entire marketplace. So private bubbles can tend to harm the economy, but not with great lasting effects. The most recent bubble, the real estate bubble, had significant government involvement in creating it, and was wide-ranging through the economy, and we still haven't recovered from that. So still the principle is you have to really know the government and the stability of the rule of law in the places you're going to invest. Looking at China relative to the rest of the world, in 1961, almost looks like about 1% of the world's GDP and a little over 20% of the population. It stays around 20% of the population, but you can see they're slowly closing a staggering gap. So again, a little bit of of proof of the fact that these emerging markets will continue to close the gap and should be higher growers than the more developed markets, assuming a stable government. And then finally, in Latin America, Brazil, if you look across the bottom of the chart here first, you'll see that they had pretty good growth in the first 2 decades, poor growth in the next 2, and good growth in the last decade. The main reason for that slow growth in the middle 2 decades was hyperinflation, and we'll see a chart on how great that hyperinflation was across Latin America. But that, again, that's an example of bad government stagnating the growth of the productivity of the people. And again, you see Brazil remains with a lower GDP percentage of the world than their percentage of the population, so they have room to regress to the mean and have a higher outperformance than the developed markets. So the attractiveness of these markets in Latin America, we see 6 things that call us to want to commit some of our portfolios there. First of all, a favorable macro environment that we'll discuss for a while. There's unique access through private equity to the emerging market consumer, which is really the driver of a lot of the growth in Latin America. There's a history of private equity underinvestment compared to other areas. The managers are high quality and tend to be higher quality than other emerging markets. The valuations are relatively moderate, and there's limited leverage there, so there's much more of a need for equity than you would see in a more developed market, and an improving exit market. There's 5 countries that we've identified that we think can have higher growth potential unencumbered by failures by their governments. Those 5 countries are Brazil, Peru, Mexico, Chile, and Colombia. There's some common themes across these 5 countries. 4 of those I put into the causes side of the chart, which are they have democracies and they have a rule of law. Actually, the more important of these is that there's a constant rule of law, meaning specifically that the laws are known and that they're applied in a non-corrupt and impartial fashion. And these countries have moved a long ways towards establishing that. They have price freedom and stability, sound public finances, and improved legal and regulatory framework. The effects that are caused by this is they've all experienced high economic growth, and they all have a very much expanding middle class, leading to opportunities to invest in businesses that cater to that group. There are specific differences between the different countries and the levels of risk that have to be considered as you're investing. We'll talk briefly about the differences between the countries as we go on. Why do we prefer LATAM, or why would one choose LATAM versus other emerging markets? And again, it goes to the strong legal environment, and including the legal, regulatory, and corporate governance for institutional private equity investments. The growth in those markets is truly propelled by the increased wealth or increased incomes of the consumer and the middle class. There are fewer GPs there, but they're of a higher quality with longer proven histories of buying companies, proving companies, and exiting companies. And there's tested exit markets that are available for the companies that they generate. So looking a little bit more specifically at the 5 countries, starting with Brazil, the largest of the countries. And the points about Brazil generally apply across the board, so I'll try to not repeat these for each of the countries. But the opportunities are there's high economic growth, there's an expanding middle class, and there's highly skilled GPs. Brazil, because it's the largest market, is the market that first attracted a lot of interest in private equity, or the most interest, is probably a better way to put that. And as a result, has more GPs who have done more transactions and exited more transactions. The risks, currency risk, and then in the large cap space, there's been the most interest in Brazil, so there's the largest amount of capital chasing deals there. So prices have a chance of being elevated relative to the rest of the Latin American market. Chile, politically and economically stable, free market, and highly productive people. There's one think tank actually has an economic index of economic freedom, actually rates Chile higher than the United States on that index. So it's adopted free market principles very strongly. Because of this, there's less risk. Because of this, more investors are willing to put money in a deal there because the downside of political instability is less. Because of this, the prices tend to be a little higher, so you're paying full prices in a Latin American sense for these businesses there. 2 countries not as developed as the prior 2, Peru and Colombia. They're experiencing even higher economic growth as a percentage because they're coming from a lower spot. very rapidly declining poverty, and these two countries have much lower private equity penetration than the other two countries. The risks, Peru will talk a little bit about recent political uncertainty in that country, and the economy is highly correlated to commodity pricing as they have lots of mining in particular in that country. Mexico, closer to home, has a little bit differences. It has relatively low valuations, has very little private equity historically in the country, but it does have an expanding middle class. So in Mexico, it's going to be harder to find a group that you feel like you can access to do private equity investing, but if you do find a group you're comfortable with, they have a great opportunity within that country. Some of the risks that are a little different, very heavily influenced the economy by certain families that have very large holdings in different industries. And there's a correlation to the U.S. economy that you wouldn't get in the other four countries. One interesting fact about Mexico that I read in The Economist a few months ago is today the price of our manufacturing labor in Mexico is almost equal to, it's a little bit higher, to our manufacturing labor in China. If you go back a decade, it was 5 times more expensive in Mexico. So a lot of offshoring that U.S. companies may have done to Asia in past years, Mexico will be a more likely place for it to land than it would have been 5 to 10 years ago. So it's a good opportunity for Mexico to pursue. So I wanted to talk about some of the political risks because they exist within Latin America. One example is in Argentina, a country that's not on our focus list of countries in Latin America. They've recently nationalized YPF, the national or largest oil company. I guess it's now the national oil company of Argentina. In 1999, that company was acquired, a majority interest was acquired by Repsol, which is the Spanish oil company. 2001-2002, during an Argentine economic crisis, the government implemented domestic energy price controls and limits on oil exports, so there's government interference in the marketplace, as one can conclude whether it's as a result. But in any event, during the subsequent period, the oil production in Argentina has decreased by 3% annually since 2000, so a dramatic decrease in the amount of oil. In 2010, they made a huge discovery of shale and oil gas field, and in April of this year, or of last year, Argentina announced that it was nationalizing the majority interest that Repsol owned without announcing any compensation. There apparently are discussions of some sort of compensation that Argentina feels it needs to do, but again, the sort of risk you face in Latin America, that's an example of it, example in a natural resource industry. Peru, one of our focus countries, they are not without their own difficulties. In June 2011, President Humala won the presidential election. He was one of 5 candidates, and then there's a runoff of 2. Of the 5 candidates, 4 were free market candidates. You could generally describe him. President Humala ran as a socialist candidate. But in his governing, because of the growth, he's done really a surprising and very good job of governing to keep free market and the growth of Peru going. But to give you an example of the sort of unrest that can face a country like that, in November of 2011, there were widespread protests of a mining operation that was a project that was going to begin that was a $5 billion investment in the project, and they suspended that project as a result. The next month, he replaced 10 of his cabinet ministers, and 6 months later, he replaced 6 more of his cabinet ministers. So if you can imagine our government, a president replacing 10 ministers or cabinet members at once or 6, just shows you the difference in the sort of the political environment that one has to take into account as they underwrite deals and determine what sort of return they're pursuing and what risks they're taking in those. The common theme between these two is both are caused, these unrests and turmoil, in the natural resource area, which is kind of the first place that politicians look when they're looking, well, when there's problem, because natural resources, because they're extracted, tend to be better political targets than an eyeglass store, for example. So with all the risks laid out on that side, I want to talk about some of the really positive economic developments in Latin America. So you can see the 5 focus countries that we've talked about here. And again, each of those countries have experienced large growth in GDP, and I'll have to flip the page here. The different statistics are on different years. This chart is done on purchasing power parity, which is in the footnote, which I can't read, which is an international dollar calculation of what a basket of goods could be purchased by the average person with the average GDP in 2000, each year, 2005, 2010, 2015. So it tries to equalize everything in the calculation, currency, fluctuations, et cetera. So in any event, this shows excellent growth. And you think back, there haven't been histories, long-term histories anywhere of over 4% growth, and mostly only in the United States for more than one century. These are excellent growth rates as these countries move back to the mean and close the gap between the more developed countries and themselves in terms of the people's productivity. And again, these show the average person enjoys, over a 15-year period, 2 to 2.5 times as much stuff than they had previously, and that stuff is stuff private equity firms want to have companies to sell to them. You also see one of the reasons we like certain Latin American countries is there's a larger base of income and wealth to build off of than in the developing Asian markets. So you can see all 5 of our focus countries have a higher GDP per capita than the 3 large developing Asian nations. Also, as people move from poverty to the middle class, the political and social stability increases, and it supports sustainable long-term growth. And you see this is an example of Brazil from 2003 to 2011. And maybe most importantly, you see on the right side the poverty level, the 2 lowest groups, groups D and E, have 33%. 33% of the people fall in those groups, compared to just 8 years ago, it was almost 55%. So 22% of the population has moved from the lower area up into the middle class or even to the upper class in Brazil. From an investor's point of view, looking at that 55%, that's a large part of the target market. As those people get another $1,000 or another $100, another $300 a month of income, they're going to spend differently than they spent before they had it. They'll spend $100 educating their kids to put them in a better private school. They'll spend more on food, sometimes going out to eat. They'll get better eyewear. They'll do all sorts of better things in health care. So there's a whole bunch of things we take more for granted in the United States of types of consumption that they're getting to do for the first time in these Latin American countries. When a department store opens in certain, not the central cities, but the next tier of cities out, people line up all night so they can go through for the first time through a department store. So there's a consumer that's hungry to consume and is earning more and more income as their country becomes more productive, and that's an opportunity for private equity that we hope to be there to participate in meeting. Another favorable economic environment, this one goes to good government. You can see the left-hand bar, the blue one, is the average inflation rate from 1980 to 2000. You can see the crazy numbers, up to 265%. You see the last 5 years, the gray bars, very reasonable numbers of inflation across these 5 countries, again, relating to better government. And that's had a dramatic impact in their credit ratings of the country. You can see very few investment grade ratings on the left in 2000. By today, all the credit ratings for these countries have moved to investment grade. Again, sound public policy is making it possible for the countries to advance. So I mentioned earlier that the consumer is a real place to access for your investing in private equity, in any type of investing, in Latin American investing. But in that area, private equity is really the asset class that can effectively invest in the growing middle class consumption in Latin America. This is an example of Brazil, a more developed market by comparison to some of the other focus countries' market. And you see on the right side, the Brazil GDP in 2011 by sector, the consumer is 52% of the economy, but on the left, they're only 27% of the market cap of the Brazilian stock exchange. So as a result, if you want to invest in the consumer, the best way to do it is in private equity, for this reason, for one, and other reasons as well that we'll touch on a little bit. In addition to great chance to access that investment, it's also very important for exits. The marketplaces, because they want, if you're a public market investor, you want to be able to diversify your holdings. You want there to be more consumer companies listed on these stock exchanges. And so when those companies are growing to the right size, the IPO market will be there wanting to find good companies that can be taken public so that the big pension funds and other public investors in Latin America can have access to more and more of the consumer market that makes up such a large part of the economy. Now, in terms of size of funds in Latin America, and we've divided large cap versus mid cap by whether it's $1 billion fund size or larger, you can see there was never a large cap fund prior to 2010. In the last couple of years, there's been almost, it's about 70% of the capital raised has been in the larger fund size. We're focused more on the middle market, the smaller end of that fund size, because we think those are the type of companies where the best opportunities exist. But this change has had a positive benefit to that as well. Having the large cap sponsors in there means the middle cap sponsors can build up companies to a certain size, have an opportunity to exit those in sponsor-to-sponsor transactions that didn't exist before as well. So we think there will be a trend which makes more of those deals happen, but also the mid-cap space is still underweighted in terms of capital chasing deals, which will make good deal dynamics in the mid-cap space. And this is the statistics, 71% in large cap and 29% raised recently in mid-cap. There's also not a lot of private equity money raised for Latin America. This chart is a 10-year average of the money raised as a percentage of GDP. And you can see Brazil's at 0.2%, the rest of Latin America is at 0.1%, and Mexico's at 0% of GDP. So very small amounts raised relative to more developed markets. So we don't think there's an over concentration of money chasing private equity deals relative to the size of the economy. Similarly, as compared to other emerging markets, we think Latin America has room for private equity growth. If you look at the right-hand chart, this takes the GDP of each region that people generally describe as emerging markets and compares those in a pie chart. So you can see the largest region, total GDP of developing Asia within that set is 51%. Latin America is 20%. You then go over to the left-hand pie chart, and you see where the private equity fundraising has been done. And you see it more or less balances out in most of the regions, except Latin America. Only 10% of the private equity fundraising has been done there, as compared to 20% of the GDP of the entire marketplace. Oh, they're beeping. So I'll just very quickly, so here's some of the themes and sectors we're focused on. As I've said, we're focused on the middle market. Looking at the right-hand side of this, there's two reasons that GPs can add a lot of value. One is professionalization of companies. So these are many times founder companies that don't have adequate books. So a forensic capability to look at what you're buying is important to start with. But then secondly, when it's cleaned up and has more developed market characteristics of how it's managed, it becomes a more valuable asset. Also, historically, many fragmented marketplaces exist, so the buy and build capabilities are very large. And then finally, the themes we're focused on are sectors where there's a comparative advantage you see on the right side of the chart, and that tends to be in the natural resource area. But again, you have to be careful and make sure you're confident that you won't be a political target. Bottlenecks that have come from being an undeveloped economy, and most importantly, the consumer section of the marketplace, which education, healthcare, security, retail, consumer, and financial services are places we've focused a lot on. So I hope that's a good overview of where we are in Latin America, and thank you all for your time.